Hello, my name is Rans, and today we are going to analyze a company in a very interesting industry. In fact, we have greatly used the services of this industry, particularly in this lockdown. It has really helped us during the lockdown, right? But before we begin, important reminder that this is not investment advice. The purpose here is just to understand the basic financials of the company so that we can decide whether we want to study its business or not. All right, let's get started. The company that I'm talking about is Bharti Airtel, and obviously the industry is telecom. Right now, I think it's obviously now a lot more than telecom. Primarily, I think we should call it internet-based companies, right? That provide us internet services, right? So mobile, broadband, DTH streaming, we all know, right? We've been using its services a lot during this lockdown. Now, we'll first start with the financials and then we'll wrap up with the highlights as always. Okay, now, if we look at the revenue here, you'd see that the revenue has had a very good sort of growth till this point, but after this, it started declining, and then it is now again in sort of a revival period, right? So, this is the story of the revenue, and this is more or less the story with EBIT and with PATs is slightly different, but with EBIT as well. If you look at here, if this seems to be like an exceptional year, right? But it was slowly increasing, but then it started falling, and then it was at its minimum here, and then it has again started to revive. With PAT, I think again it's a similar kind of a story till this point. These 2 years were very difficult for the company, and here there is an exceptional loss, which is most likely due to which is majorly due to the AGR rulings that have come out, right? So it would be interesting to see how that goes forward as well, right? So overall, you could see that it was going very well, but I think obviously we all know what happened to the telecom industry with the introduction of Geo and how the industry was literally disrupted, right? And now there are only three players. Okay. Now, the thing that you'd see here is obviously there is a vast difference between PAT and cash flow, right? So even if you look at these multiples where I have here down here, so CFO by PAT is 327.4, 528, more than 10 times, right? 6 times, and all of that. The reason for that is that the company has very high depreciation charges and it also has very high interest charges, right? So depreciation is non-cash and interest gets reclassified to cash flow from financing. This is why the cash generation has been solid, right? If you look at the overall cash generation, it's here. And if you compare it against the revenue, right, you will see it's about 30%, 29-30%, right? Because the profit margins here are not really, helpful about what to make of it. So I think I'll just show you that how the cash flow from operations compares against the revenues. It's around 29%, right? Cash flow from investing activities, the company has had to continuously make investments in its fixed assets. Mostly it relates to fixed assets only, right? So we don't see any of this infrastructure on a daily basis. What we have are just the phones and laptops and internet, but behind all the services that are provided to us, there is still a substantial amount of infrastructure that is required, and also a large part of India is still getting the hang of the internet. There are large number of 2G and 3G users as well, right? And not everyone is using 4G or upgrading to 5G. So there are massive infrastructure requirements, and you can see that the company has to regularly reinvest, right? Although it has a solid cash generation, but still their investments that it has made, the cumulative investments are actually greater than the cumulative cash generated, right? Which brings us to the cash flow from financing, right? So cash flow from financing, it's understandable that it's high positive, high negative, it's fluctuating, right? So the major transactions with relating to the cash flow from financing activities are, first of all, the borrowing transactions. So the company had significant borrowings and it had to obviously repay its borrowings. Then it raised new borrowings because it also has to make a lot of reinvestments into the business as well. So, and then there are slight dividend payments as well, which were made by the company, right? But majorly it's related to borrowing transactions, repayment, issue of new borrowings, and interest costs as well, right? Now, equity here, you'll see that, I mean, if the broad trend, if you compare FY11 equity versus FY20 equity, then uh, it doesn't look very good, right? And there seems to be one off year here when it suddenly fell by almost 20,000 CR and then it went up by 27,000 CR. So this is something that we'll have to look at if the company issued new equity here or if it bought back something here, whatever the reason behind this is. So this is something that we'll have to figure out that what is the reason for that. right? Current assets have gone up by actually almost 6.8 or 7 times versus almost only a 1.5x growth in revenue. So we'll have to check out that what are these current assets. And if you look here in this year particularly, the current assets have gone up, right? And if you look at the current liabilities, if you compare the current liabilities and current assets, you'll see that the current liabilities started with a fairly high number, right? So and it has always been greater than the current assets. But again, even in current liabilities there is a major increase here. So current liabilities include short term borrowings as well, apart from the usual trade papers, and here there has been an increase in provision due to the AGR dues that also led to the decline in profit. And the increase in current assets, I checked it up because this did not seem very usual. It was because of a cash influx, and it seemed that the company raised money through equity issue. That is why it got cash, and it had some borrowing transactions as well. So that is also happening. So that is why the sudden almost 2x, more than 2x. In fact, it's an increase of almost 44,000 CR here. So it is due to a couple of factors. One is an increase in other current assets, and one is an increase in the cash balance as well, right? So that is something about it. Non-current assets, 2x growth, we've seen continuous reinvestments into the non-current assets, right? The cash flow from investments, right? So it's continuous growth. And obviously, if you could look at such a high asset base, so even a 10% depreciation on these assets would be very, very material, and which is, putting pressures on the EBIT margin as well, right? So uh, it's almost 2,57,000 CR, right? So 10% of that is also 25,000 CR. So now you can imagine the quantum of depreciation that the company has to go through, right? Okay, now coming to the growth, we've more or less talked about the growth. If you look at here, then revenue growth has been good in, let's say, in this year, a couple of more years greater than 10%. Apart from that, it doesn't look very good, right? With EBIT as well, I mean, EBIT has been volatile, good year here, couple of bad years here, couple of good years here. Then I mean, it's not been very good. With PAT also decline, a couple of very, very good years here, a normal year here, and two very poor years here. I mean, this doesn't even make a lot of sense because it's just going from 38 to 54 year, and then obviously this is an exceptional year. Cash flow from operations, cash flow has been majorly been good, and I think it's been strong. In a couple of years, it's slightly declined, but it will be interesting to see how this picks up, right? Equity, one important thing is to check for here that what happened. It probably seems like a new equity issue, but we need to check it out, right? Current assets have constantly been increasing, continuous reinvestments, right? With not net working capital, or rather I should say current assets less current liabilities. Current liabilities have always been greater than current assets. I don't know if it's the best of things, right? Because there are substantial short-term borrowings as well in current liabilities. Liabilities, the non total liabilities, not just non-current liabilities, have kept on increasing. So there's been a lot of issue of debt as well. Okay, now coming on to the metrics of the company, if you look at return on capital and return on equity, the numbers are not very good. In fact, I mean, there's not even been a single year. Okay, there has been just 1 year where either of them has been greater than 15%. So the max return on capital was back in FY11 when it was 17%. The max for return on equity was around 11.8%, which was 1 year prior to that, right? So the recent performances don't look very good, which is obviously due to a combination of different factors playing here, right? The EBIT margin, if you look here, then probably during these couple of years it was good. It revived a little bit here as well, but then obviously in the recent years, not so good, right? PAT margins are quite thin, right? So if you look at from here to all the way up to here, even if we omit the last year, right, then only the highest is actually 5.2, right? And the highest in 10 years is 9.7. So this obviously looks like a big cause of concern, right? Okay, so this was the margins of the first element of the return ratios. The second element is the capital turnover and asset turnover, respectively. Obviously, the company has a huge asset base, right? And it seems that the utilization aren't as efficient as it probably could be. We might want to compare it against the other telecom operators, but the trend here seems to be one of decline, right? So if you remove the first year, and from here the trend has broadly been of declining. It had a one good year here, but apart from that, the broad trend hasn't been a favorable one. Okay, now coming to the leverage position, the leverage and the solvency positions, the asset upon equity has actually been greater. The financial leverage, so to speak, has been greater than 3x in almost all of the years. So this is also very close to 3x. This is also very close to 3x, and currently it stands at its highest. So 4.67, which basically means for 4.67 rupees of assets, only one worth of it is financed by equity. The rest 3.67 is financed by debt or liabilities, whether it could be short term or long term. So that is something that it doesn't seem very favorable. The highest it was 5.03, and this is something that is understandable, right? Because the company has extremely high capital requirements. The capital turnover or the asset turnover aren't extremely high, or I mean, they're not even. So the company isn't even able to produce 1 rupees of revenue for 1 rupees of capital or 1 rupees of assets, right? It's only producing 0.5 of revenue for 1 rupees of capital or 0.26 of revenue for 1 rupees of assets, right? So it continuously requires funds to reinvest, which obviously aren't generating the revenue that is equivalent to the amount reinvested. So it needs external capital, and it is natural that the company will go externally for debt, right? The net cash flow figure here is not the most meaningful one, right? We've already discussed CFO to PAT, but the net cash flow is not the most meaningful here. The reason being that there are a lot of high value transactions in multiple tens of thousands of crores related to borrowings, right? So I think that is, it would be better if we look at a breakup of these, right? Current assets less current liabilities, you could see it's almost always been negative, right? It's been the highest in the recent 2 years, right? Despite an increase in current assets as well, the cash position. But obviously there was a larger provisioning that was required with respect to the current liabilities. Although, I mean, it would be very, very crucial to see how the court rulings play out and how the companies have to pay the money, right? So I don't know if such a large negative net working capital is a good thing or not, right? Because there are short-term borrowings as well. There are significant amount of trade payables as well, right? And with such a large deficit, the company regularly needs capital in order to even keep its short-term functioning afloat, right? So that is something we need to see. The non-current liabilities to equity, right? It stands at its highest right now, which is okay, no, it's not at its highest, but it's the highest in the last 5 years, right? So the highest is 1.74, but in the last 5 years, it's 1.40, right? So the company is currently been constantly been raising, right? Because if you look, there is a major net increase here and a slight decrease in these couple of years, and then again a raise here, right? Which basically means that there are more non-current liabilities than equity as part of the capital. All right. So that was more or less it that I wanted to explain with regards to the financials and metrics. Let's quickly wrap up with the highlights, right? So revenue, EBIT and PAT, they seem to be in a recovery phase, right? And it is obvious after the massive disruption that the industry went through due to Geo, right? EBIT and PAT beaten down in the last 3 years, and FY20 losses due to the exceptional item, which are the AGR dues that we discussed. Massive difference between PAT and CFO due to depreciation and interest. That is something that we also saw with such a high asset base. Even a 8 to 10% depreciation rate makes a lot of difference. Cumulative CFO stands at almost 30%, or rather 29% of revenue, right? So that is a meaningful way to understand the cash generating capacity of the business, right? Because the profit is not really meaningful at this point of time. Continuous asset purchases, that's what we've seen. The company requires lots of capital and assets. Most financing flows relate to borrowing transactions with some dividend payments. So I looked at the breakdown of the cash flow from financing, and the company has regularly been paying dividends. The amount was lower in these years, but it has steadily kept on increasing. But then obviously there are significant amount of borrowing repayments as well, and in order to fund the borrowing repayments and in order to fund the asset purchase, it has to keep on raising borrowing. So that's what seems to be happening. Current assets have grown by 6.8x. This is something that we've seen, right? So it was a lower base here, and then it was almost more than double here, right? So from this point to this point, it's almost about 3x, but here the sudden increase due to issue of equity. That is what seems to be the case. Equity has gone up by only 1.5x versus a 1.9x increase in non-current liabilities. The company has raised both equity and debt capital in FY20, and it has repaid also a significant portion of debt capital. And but still, if you see the the balance of non-current liabilities has increased. So that probably gives you an idea about the quantum of debt that we're talking about, right? Non-current assets have increased to nearly 2x. That's what we can see from 130,000 CR to almost 257,000 CR versus a 1.5x increase in revenue because of the poor performance, poor revenue growth in the recent 3 to 4 years, right? So this the revenue growth would be expected to obviously pick up. Let's see how well it can improve its asset utilization rates, right? Because the asset utilization, the capital turnover has been less than 1x and asset turnover less than 0.5x in all of the last 10 years, right? And this needs to improve. This would also improve as the revenue per user, average revenue per user improves. But this remains to be seen how this plays out. Return on capital and return on equity greater than 10% in only 4 and 2 years respectively, right? So this is understandable due to a combination of low margins and also very low capital turnovers, right? So that is why these return ratios don't look very attractive. The EBIT margins have been inconsistent, as we saw, and the PAT margin has been very thin in most years. In fact, we saw that probably 5.2 was the greatest in the last 7 to 8 years, right? So it's not the best, to say the least. Financial leverage has been greater than 3x in 8 out of the last 10 years, not 9 out of the last 10 years. And it has been near 3x in almost all of the years. NCL equity currently stands at its second highest, it's not the highest, at 1.4x, right? So that is something that we've already seen. So what's the conclusion? The conclusion is that it has very good cash flow, right? But challenging margins, to say the least, challenging asset utilization, and high leverage, right? So if you look at here, the non-current liabilities are even greater than the revenue, right? So this seems to be a very, very tricky position because the company is not generating enough cash to reinvest, then it also has borrowings to pay, the asset utilizations aren't great, so high leverage has to be there in order to keep the business going. So yeah, that is what I understand from the basic financials of the Bharti Airtel company. Now it would be very interesting to see how this plays out, because the industry obviously seems to be in a turnaround phase with so much internet usage, so much digital connectivity and everything going forward. But it still remains to be seen how this plays out. The company's ARQ and everything, they seem to be increasing at least. And obviously with the power of internet and internet reaching out to the furthest directions of our country, furthest corners of our country, it seems that these companies might be able to make a strong run fundamentally as well. But at the moment, the financials are challenging, to say the least. But the industry future looks to be bright, right? Because with all the internet usage that's going around us. So that is all that I had to share on this company. If you found this helpful, then please share it. Please subscribe to the channel so that you can keep receiving more videos about investment analysis. If you have any feedback for me, if you wish to discuss anything, please let me know. To find a copy of the Excel sheet, you can look into the description, or to sign up for the email list, you can find the link in the description as well. So that is all that I had to share today, and I'll see you again with another company. Thank you so much for watching.